Everybody, first off, I want to thank you for taking the time out of your day to get to come here, your evening. I appreciate that. If there's any questions along the way, if it's all right, I'm happy to take the questions as you have them. If you want to save them for the end, that's fine as well. Disclaimer, I'll leave this. It's going to be on our website. It's also in the presentations that you have. So a lot of this, I'm not going to be reading through the slides, but you'll have access to it when you want. So the opportunity here at Nostra Terra, want to point out first off, our market cap, we're very small right now. Our market cap's about 3-4 million sterling. Closed today, I think we're about 3 million sterling. And if you look at our assets, we've got and this is just our reserves. We'll get into the details here in a moment. Our foundation of our assets, we've got proven producing fields, proven producing reserves, and then we also have some speculation, if you will, some assets that haven't been drilled to add additional upside. So our proven reserves, you're looking at 760,000 barrels, future net income of approximately $15 million, and PV9 of that at $7.5 million. Total 2P, including the expansion of the Mesquite asset that we had recently acquired, takes us to about 2.5 million barrels of reserves, 2P reserves, proven and probable. $59 million of future net income, and PV9 of $24 million. We've got 2 new wells that we're permitting right now that we'll plan on drilling here shortly after getting those permits. Something else I want to point out is on these reserves, there's a little footnote here, as small as it is, it's important. The reserves were done, they were performed by a third-party engineer that works for the bank. We have a senior lending facility with the bank. It's a very good facility I'll touch on. And that is done by a third party, and at the end of the presentation, in the appendix, there's also the price deck. So in addition to being conservative in the various areas of how the assets are operating or how they anticipate they'll operate, we've also used a price deck where you're looking at about $50, $51 oil prices. So the figures that we have here, we believe are relatively conservative. Specifically, something that I think is important to understand is the proven resources we are producing already. So on something like that, I like to look at the future net income because we are receiving revenue every day, every month, every year. We've been producing these assets. We know what they do. We take that money in. We make money in the field. That goes to the PLC cost. So these are pretty strong figures, we believe. Who we are as a company, we're focused on onshore U.S. We want jurisdictions that are safe. We want something that's low risk for political risk, low risk geologically, and we have that in the U.S. It's one of the lowest risk political risks around. On geological risk, we're in proven producing basins. So we're in fields that have already been drilled up. We have wells that are already producing, as I said, but we also are going to drill new wells around in these producing fields. So this is not rank wildcat. There's no exploration involved. It's proven, everything that we're doing. The foundation of the assets in Texas, most everything, actually all of our assets at this point are in Texas. They're conventional reservoirs. They're not unconventional. So these have shallower declines. They're more predictable. We're 100% oil right now. And as I mentioned, we have a senior lending facility at 5% interest rate. So the bank, as I mentioned, they have a reservoir engineer on staff who assesses our reserves. They get into every single well. They look at the declines. They look at the operating costs, production on every single well. They look at our overheads on running everything in the field as well as in the office, and to come up with their valuation on that. To do that, they're giving us a 5% interest rate. It's one of the better facilities around. It's not something that you often see in oil and gas, and especially in the exploration, because you can't get debt like that on exploration. Okay. You also can't get debt in a lot of foreign jurisdictions if you don't have that predictability, the ability to collect these revenues, the ability to get all that in. So this says something. It speaks to the quality of our assets as far as the bank wanting to see that production, they want to see that profit, and they want to see the management team that can handle that, hence the reason why we got the facility. Our board is 3 directors. Our chairman is in the back of the room. If there's any questions, any conversation later, he's available. He's always happy to talk about the company. So I'll talk about him for just a moment. Ewan joined the company a couple of years ago. As I mentioned, we're very small. During the downturn, we repositioned the company. We've been repositioning the assets when oil prices had dropped significantly. We also wanted to reposition the board and strengthen our board with the ambition that we have as a company. Ewan is it has experience in being involved in companies in an early stage and seeing them through to becoming a much larger companies. Most recently, he was the CFO of Gulf Keystone, where he was, again, one of the early stage employees there, helped get the company pre-production, pre-discovery to the point where they were, multiples of where they were, helping raise over $1 billion debt and equity for the company. So that's the kind of experience that we had brought to the board to help us as we grow going forward. We've also brought on John Stafford. John had joined Gulf Keystone as well, early stages. He was the fourth in the technical team. Then he led the technical team to the point where there were over 12 senior staff in the technical team alone, 300 people in operations that he led. So starting from a small company, growing that into something more substantial. Again, that's why we brought Ewan and John onto the board. The assets in the U.S., as I said, we're focused in Texas right now. Most of our experience is mid-continent U.S., so that's going to include Oklahoma, Kansas, Colorado, even into Wyoming, a little bit of Louisiana as well. But the assets are in Texas, and we're on both sides of Texas, in the East Texas oil field with Pine Mills, West Texas, and the Permian Basin. Something that I think is pretty interesting when you look at this, you look at the blue outline, the thin blue outline there, that's the extent of the Permian Basin. And what we did was we overlaid the UK to get an idea of how big the Permian Basin is. So if you want to try and compare the Permian Basin to, say, the Wild or the Wessex Basin, or to the North Sea for that matter, size-wise, the Permian Basin covers all of it. Well, we've got a portion of that. It's a very active area. Now, you're only looking at the aerial extent here. The other thing to keep in mind is that you have a lot of different formations. We call them stacked pay. So if you think about pancakes, I know that's not the breakfast of choice here, but stacked pancakes, and each of these is a formation, an oil or gas-prone formation, that you can drill horizontal wells into these formations, all from the same pad, and have wells. You can have up to a dozen different wells in some cases because they're all very prolific. That's why there's been so much activity that's gone into the Permian Basin recently. It's the most active oil field right now. BP is the one that made the most news over here when they spent $10.5 billion in the last couple of years to buy into the Permian Basin. Now that's them getting a position that they expect, that they plan to grow $10.5 billion on the acquisition alone. Another company that had gone in and done that is Concho Resources. Concho was already in the Permian Basin. It's a company I would guess that nobody in this room has heard of before. Concho market cap of $30 billion, so bigger than most of the companies, bigger than most oil and gas companies in London. And the reason I'm mentioning Concho, with a $9.5 billion acquisition they did recently to expand, one of the co-founders of Concho, VP of Exploration for Concho, had created Trey Resources. He left Concho and created Trey, and Trey is who we brought on to help us with the field development plan of one of our assets. So the name of the game for these companies in the Permian is going into these existing fields that have vertical wells all around. They've been drilled for years, for decades, and taking them horizontal, doing the horizontal wells, introducing modern technology to these fields so you can extract a lot more oil. And that's where Concho had grown to be a $30 billion company. That's why BP had bought in, and that's why we've engaged Trey again. So now on to the more specifics on the assets, starting over in East Texas and Pine Mills. Pine Mills is something that we own 100% of. We operate it. There were 3 previous operators, 3 previous years, all lost money. We took over operations within the first month. We turned it to be profitable. We've made money since we bought that. Okay, we're doing pretty good with that field. So far, what we've done is mostly workovers and reactivations. We have not drilled a new well. In the last period, 2018 to 2019, mid-year, we actually increased production without drilling a new well. That's not an easy thing to do. So we manage our costs pretty well. The upside that we have there that we haven't exploited yet is some of the bypass pay. And that's something that we have available for later. Our licenses, or our leases in the U.S., are held by production. Because we're already producing, there's no risk of expiration of these leases. So we can go and get the bypass pay later. So that's banked, if you will. And we're saving that for a future time, where it allows us to put our money into focusing, growing that foundation a little bit further before we grow Pine Mills. Here's a separate slide, talks about the valuation, our reserves. Touched about this on the beginning, and I'll hit it at the end as well. Into the Permian Basin, there's 3 acquisitions we did in the Permian Basin during the downturn. We were able to do some acquisitions of just a few barrels a day. It's nothing exciting. It wasn't meant to be exciting for that reason. But what we did when we acquired this was we acquired the ability, these other locations that had not been drilled yet. And again, because these wells were already producing the other wells, doing a few barrels a day, that allowed us to hold those leases in perpetuity without any risk of expiration. So when we did that, we banked those locations for the future. We ended up drilling later. I want to point this out. These are the 3 areas, the darker colors here. In this area here is where we drilled the twin well. Every one of these are wells. This is a square mile. Each of these squares is 1 square mile. I guess you could fit the city in there, I suppose. In an area like this is 1 well every 40 acres. So the idea is that each well is going to drain that area, and that's what it takes is the 40-acre spacing. Until somebody says, well, wait a sec, if we drill a little bit closer than that, we still have a good well. It hasn't jeopardized the wells next to us. These new wells are coming on strong. That tells us that the 40-acre spacing didn't drain that reservoir either. So let's go tighter spacing. Then the wells in the middle here in this swath, these are mostly on 10-acre spacing. So it starts to come to the point where you say, well, wait a sec, if you're drilling this many vertical wells, what about just drilling 1 horizontal well and getting after all of the reserve that's there? And of course, a horizontal well is more expensive than a vertical well, but how many vertical wells to a horizontal well? And that's where it comes down to the economics and the development plan on which one is more effective. So we drilled a vertical well shortly after we acquired this. Oil prices during the time that we had drilled were about $50, $60, and we got payback on that in just under a year. That's not an easy feat to do. At $100 oil prices, most companies don't do it. It takes closer to 3 years. We were able to get payback of that, all of our investment back in just under a year on a vertical well. So what happens if you were to go into a field like this and now start doing some horizontal wells? It gets even more exciting. So again, these are something that we have more of these locations that are banked, these locations that we can drill in the future. But it shows that we were able to pick good locations to drill, that we can make money, and we can do this in the current oil price environment. We don't have to wait for higher oil prices. I'll just point something out on here on the photo. If you look at the tan areas, each of those tan areas is a well that's producing. This isn't the most pronouncing one of the pictures, but it does give you an idea. These go on and on and on. There's wells everywhere. On to Mesquite, we went and acquired into again, another area that's been old producing area, been producing for some time, a lot of vertical wells that have been drilled, but the rock looks to be the type, it's a tighter rock, where it makes sense to do horizontal drilling. And that's what we felt. Trade Resources actually felt that as well separately, part of why we had engaged them. We acquired the Mesquite asset from Tall City. We did that about a year ago. We engaged Trade Resources and to do the field development plan on what it looks like to do horizontal wells. So the area in yellow are the areas that we have leases on currently. We do plan on expanding that position further. But we can drill 4 wells right through the middle of that right now. If we add or to drill shorter laterals or all of our acreage, it ends up being effectively net 8 wells that we can drill. It's pretty exciting, again, when you look at our current production versus what these add on future production and reserves. One other thing I actually want to point out before we move on, if we were to drill vertical wells instead of horizontal wells, then these are all proven reserves. The engineers have already looked at this and say, you're surrounded by production. You know, how far is the closest discovery? Somebody had asked me at one point. There's no discovery that's so many miles away. We're in the middle of producing assets. We're long past discovery. So we're a mile away from production on one side, 2 sides, 3, all 4 sides, we're surrounded by this production. So there's no question if the oil is there. We know that the oil is there. It doesn't disappear for 1 mile and then pick up again. The question, again, comes down to the economics on what are these economics on drilling a horizontal well as opposed to a vertical well. Just a quick image to give you an idea of what it looks like. The reason why you do the horizontal drilling, if you think about when people drill a vertical well, they don't always hit. Sometimes you can drill a well and it ends up being a gusher. You drill an offset well to that, and it's a duster. And it could be vice versa. It happens all the time. The reservoir, the oil is not a pool under the ground. It's not sitting there in a pool. It's in different pockets. It's reservoirs like this. So the idea on a horizontal well is intersecting, connecting as many of these reservoirs as possible, and that's why you do that. I won't go into detail on this, but these are the more of the economics on a single well with a 1 mile lateral. But I will point out that at $60 oil prices, you're a 44% IRR. That's pretty strong at current oil prices. So looking forward, the things that we're going for, that we're aiming to do, are two main milestones that are ahead of us: profitability on the PLC level, and after that, paying a dividend. We do want to seek towards getting to the point where we're paying a dividend to shareholders. Our growth is going to come in two different ways. It's going to be from drilling on our existing assets. We had just acquired 160 acres in this area, in the Mesquite area, an additional 160 acres, a little square mile, production on all four sides, surrounded by it. And we were able to find this little lease and pick it up from, ended up being 17 different family members. So we spent the time to do that, track them down and get that. Now we're able to drill 2 half-mile laterals in there, 2 half-mile wells in this particular area. So we're permitting one of those, and we're permitting one of the other 1 mile laterals. So our growth will come from drilling these new wells on our existing assets, but it'll also come from acquisitions. With our senior facility, the senior facility that they lend to us, that goes based off of our existing production. But if we were to acquire an asset, that's there to leverage out as well. So the facility is a $5 million facility. We currently have a borrowing base just under $2 million. But the $5 million, the $2 million figures are mostly irrelevant. If we have an asset that we put in front of them, let's say it's a $20 million asset. If that's the case, they're going to assess it. They're going to have the engineer go through and look at those reserves, look at the cash flow on that, and we can borrow according to that. So then the size, the $5 million, will now increase. So it is there for us to leverage. Washington Federal is the bank who's given us the facility. They're not in the business of they're not making much money on a small $5 million facility, $2 million borrowing base at 5%. They partnered with us. They're working with us because they see what we're planning as a company. They want to grow with us. So in closing, our reserves are rather significant compared to where we are on market cap. Future net income, $58 million based off of lower oil prices, $24 million in PV9. And want to point out that we have the ability to acquire assets. We've proven that we can do that. We can acquire assets that make money, that are already producing and making money. We also can operate profitably. We know how to operate a very good team out in the field. We can drill wells in the lower oil price environment and make money. We can pick the right locations and we can drill those effectively. And we know how to manage our overheads prudently. So the next thing for us is that scale. The focus is now getting us the scale so we can grow much quicker.
Thank you very much indeed, Matt. Okay, well, you all politely left your questions to the end, so we can take a few questions for Matt now. So who wants to be first? Okay, well, while you're thinking about that, let me just ask you, I mean, the company's been going since, is it 2005, 2006? What is the nature of the change in the company? How would you say you're different now to when you started out? You did touch on this.
Mm-hmm. So when the company started, I wasn't at the company in the beginning, by the way, but when the company started, it was because of the excitement after the Velvet Revolution in Ukraine. People got excited to go invest in Ukraine. And they had raised some money and invested in Ukraine and had a field down in the Crimea. And it didn't work out for various reasons. I'm happy to talk at length, but I think most people know
that gives us a start. Yeah. Thank you. There's a question at the back here.
In your modelling, how much do you think these horizontal wells are going to cost, and what kind of production do you think you are likely to get from them, and what kind of decline rates?
Mm-hmm. We've touched on two different types of horizontal wells. We call it a 1 mile lateral and a half-mile lateral. They will be shorter than that, but those refer to the length that you could, if the full extent of that lease You actually have to drill a little bit shorter to be within those lease lines. So that's how they're affectionately known, but they will be shorter. The half-mile lateral is approximately $1.8 million, and the 1-mile lateral is approximately $2.9 million. Production was the next question. IP rate, and I want to caution you on IP rate, and I'll get to that in a moment, but IP rate at about 265 barrels a day on the 1-mile lateral. On the shorter one, we haven't published that yet, so I'll hold back on referring to that. But what's more important is not the IP rate. The IP, the initial production rate, is a very misleading figure. And I think it's very, very important. If there's a key takeaway for the whole industry when you're looking to invest, please understand that IP rates are not what you should be looking at. People like to get excited about that, and they multiply it by 365 and start counting their dollars, and it doesn't work that way. Wells are going to decline. That's what they do. It's like opening a soda can, and the moment you open it, that fizz comes on and then drops. So the wells will come on, and they will come on strong, and then they will decline. The more important figure I think that people should be looking at are the EUR, the estimated ultimate recovery, how much is recovered, and then you factor in the declines. So you've asked the question kind of covering all the basis there. If you factor all that in, that's what a reservoir engineer does to come up with what the value of that asset is compared to the investment. And we've got this slide in there that covers every bit of that in the presentation as well. Okay?
Any more questions? Yes, got a question at the front here.
Just very quickly.
Sure.
Just wait for the mic. There you go.
Having invested in NTOG some years ago and pulled out just before I lost any money, why should I invest in you now? Because I don't see much of an impact, really. Mm-hmm. I mean, with everything you've said and everything, all the drills you've done and everything, I hardly see anything that excites me right now.
Mm-hmm. Yeah, I understand.
Why should I invest in you now?
So first off, if you look at the companies that have been around during this time, when the oil prices dropped, there's a saying, in strong winds, all wild turkeys fly. It's a lot easier at $100 oil prices, but when oil prices dropped, if you look at most of the companies that are in the U.S., they're not here today. Okay, they were sitting there doing RNS after RNS about a forbearance agreement, defaults on their loans, all these problems. We never announced anything like that because we didn't have that problem, and we faced that. We did have to get through that. It was not an easy time. But when oil prices dropped, companies have gone under, and they're still going under today, even after oil prices have recovered. They're still filing bankruptcy, still distressed, still having problems. So there's not going to be a lot of growth during that time. We did everything we could to stay alive. And as I said in the beginning, we've repositioned our portfolio. We went from assets that we weren't operating, we didn't have control over timing and how the wells were drilled, when they were drilled, et cetera. We went from that repositioning to where we've got total control over our portfolio, and in conventional reservoirs where the declines are smaller or shallower, frankly. So we've done that. As I've said, we've also repositioned our board. And now that we're at that point, now we're going for scale. Now, we haven't drilled a lot of wells recently. We drilled the twin well and the G6 well. And as I said, the twin well had hit payout in less than a year. That's pretty remarkable. But in the current oil price environment and the way the markets are, it's not getting as much attention. We're still subscale, and that's been the biggest issue. So our drive is to get out of that subscale right now with larger wells, larger acquisitions. The Mesquite asset offers that ability with the wells. The single well can have a huge impact on the company.
Where are we? You're at 190 million shares right now. Am I right? Something like that? According to
Close to 200, 190.
Okay, whatever.
Yes.
Okay, so I presume, how are you doing for funds at the moment? Or will you be raising more money through more dilution?
We're okay for funds. Going forward, we'll always have a combination of debt and equity. Mm-hmm. As I said, we have a senior facility with Washington Federal that allows us to grow. And again, banks are not giving those out if you're not making money. Mm-hmm. So we've proven that we can do that. We will have a combination, though, of debt and equity going forward.
Well, thank you very much indeed.